Cybersecurity stocks are part of my portfolio. I own Fortinet and I own Qualys, which is a much smaller cap company, but I really like them both. I have added Fortinet since it's dropped earlier this year. It dropped violently by, I think, 20% or more. As you can see here on the graph, it had a violent drawdown. But anyway, today, not only that, we're going to be taking a look at the numbers for the companies that I own, Fortinet and Qualys, but I'm also going to be comparing it to Palo Alto Networks, which is a massive $130 billion market cap, and also CrowdStrike. And I think these two companies that are here at the top, number one and number two position, are very overvalued and very richly priced. And I think you should basically stay away from them if you don't want to get hurt. But yeah, I've put these companies here in the stockanalysis.com website in the comparison tool. And we're going to take a look at the margins, at the balance sheet, cash flow, a bunch of different numbers we want to take a look at here, and then the valuation. We're going to look which is cheap, which is very expensive. And then I have already prepared this document in Excel, and we are going to color code everything and to see basically what we like and what we don't like, and what's going to show up as red and what's going to show up as green. Okay, so first of all, margins for Qualys. It seems like it has the highest gross margins. Fortinet is the next. CrowdStrike is the third, and Palo Alto Networks is the last. So our two companies that were invested are clearly much better in terms of margins. They are more profitable, bringing in more. They're more efficient, more profitable. The management team is executing better, and their products are just better. Operating margins is telling the same story, but we also want to take a look very quickly at the trend. Not just the last year numbers, but we want to know how is it trending over the past 10 years. So as we can see here, it used to be 10 years ago, Qualys was at 79, it dipped to about 76, and now it has recovered and has been on a slightly uptrend since then. Operating margin clearly uptrending since 10 years ago. Same with profit margin. So these companies are getting better and better over time. They're not just growing in market cap. There is actual substantial growth, and the management is executing properly, and they're doing the right thing when growing the company. Again, they're becoming more and more efficient. Look at this, Fortinet 10 years ago, not even 1%. Now it's sitting at 30%. CrowdStrike, let's take a look real quick what's been going on with CrowdStrike. They are still negative. Gross margins, yeah, sure, improving, and then flatlining around 73, 74. Not exciting at all to see this. I mean, they've had time to grow. For example, here, from 2020, going down to minus 10%, and they just hovered around minus 10%. This is not good. I want to see going from minus 10 to minus 5 to 0 to plus 3% to plus 5 to plus 7, something like that. Now, trailing 12 months, they're minus 6% again. What's going on? I don't want to own this, dude. Yes, it's high growth in terms of top line revenue, but just because something is growing in the top right, I mean, obviously it's slowing down here. 92%, 82, 66, 54, and down. Now we're down to 23%. So obviously it's growing a lot in top line revenue, but just because it grows here in this one metric doesn't mean that I just want to own it just because it grows here. This is not a promise that the company and the whole management team are going to make this a very profitable cash cow for me as an investor. So I want to see better signs of improving operating margins before I make an investment. And obviously the price needs to go down by a lot. We're going to take a look in the last part. We're going to take a look at valuation, and you'll see how crazy the valuation is for CrowdStrike and Palo Alto Networks. But yeah, in terms of metrics, all of the margins are much better for our companies that we own compared to CrowdStrike and Palo Alto Networks. And then return on invested capital and ROC. This is the ROIC is the average over the past 5 years. And then ROCE, unfortunately, we can only get it for the last year performance. So let's just take a look. Double digit ROIC, over 20% for Qualys, over 50% for Fortinet, which is amazing. This is 5 times more than the S&P. No, actually, S&P, I don't know. I think it hovers around 7 or 8% average, and we have 56%, which is extremely high even for this type of company. And keep in mind, Fortinet isn't just software. This is also they have a lot of data centers across the globe, and they also sell hardware. So it's not just software. So seeing these type of margins for a company that owns and leases, they own land, they own buildings, they lease buildings, and they own data centers, obviously the computers, the chips, the equipment, everything. And they also sell hardware. So there is kind of a cyclicality to their business. But yeah, seeing these these metrics is pretty amazing. And that's why I immediately bought it after it went down by a couple of, not just a couple, by 20%. I used to own a lot more Qualys, and then I just sold Qualys and also invested in Fortinet. So I had a 30% drop. I immediately put my hands on that. I'm not going to miss that. I want to be invested in the stock, obviously. Looking at these metrics, I mean, you would be kind of insane not to want to own this whenever it goes down. But yeah, anyway, compare that to CrowdStrike and Palo Alto Networks, minus 3%. That's just not good. I don't like to see that. ROIC over time. ROC doesn't even show up, but yeah, they don't have it reported yet, I don't think. But yeah, I don't like it. Obviously, in the early days they were negative, but still negative. And they had a lot of time. They had a lot of years to improve this and become positive and get closer to at least 10%, something that I look forward to in my companies that I want to buy. But yeah, this is untouchable for me. Operating margins negative and no signs of improvement. I don't like to see that. And also top line revenue slowing down substantially. Even though it's double digits, it's just 23% with these type of margins. I don't want to touch this at all. At 100, more than 100, I mean, this is supposed to be like a mature company trading at $100 billion. ROC last year, I think, yeah, it shows up here, surprisingly, minus 4% as well. Palo Alto Networks, much more mature company than CrowdStrike, so it has positive numbers, but again, these are very low numbers compared to Fortinet and Qualys. 11%, 12%, FCF margins, that's nice, but ROIC and ROCE, very unexciting to see and unattractive, and makes me not want to buy it. Yeah, and it was negative until 2022. Yeah, I don't want to buy all this, to be honest. But that doesn't mean I don't want to be invested in the cybersecurity industry. I want to own these type of stocks. There are a lot of opportunities to make money and have high growth with your investments. Let's take a look at the balance sheet and let's sort by market cap. So market cap 130 billion, total cash 3 billion. CrowdStrike kind of the same, a little bit more cash, 5 billion. And then our Fortinet is less than half compared to Palo Alto Networks. Keep in mind, Fortinet is the direct competitor to Palo Alto Networks because they have also their hardware business, and then CrowdStrike is more of a competitor against Qualys. But yeah, look at this, 4.5 billion compared to 3 billion, which is Fortinet has more in cash and much less in market cap. Net cash 3.5. Net cash compared to the debt, I mean, you subtracted the debt and you're left with this. So basically, yeah, we now have much more closer to CrowdStrike as well. Which again, the market cap of Palo Alto and CrowdStrike is very high. And in terms of percentages, cash to market cap, almost 2% for Palo Alto, not a lot, doesn't get me excited. 4% for CrowdStrike, more than 5% for Fortinet, and more than 11%, let's just say 12% in market cap. You have it in cash for this company. So massive green flags for both of our Fortinet and Qualys companies when it comes to all of the metrics, all of the margins, and return on investments. But yeah, balance sheet is pretty much pristine for Qualys and Fortinet. I would say for CrowdStrike as well, because they have a bunch of cash, not a lot of debt. Yeah, let's just say everything here is pristine. Especially for Fortinet and Palo Alto Networks, they don't have a lot of debt, and they do have cyclicality in their business, and they also have, like I said, their hardware business, the data centers, and everything like that. But just because everything is pristine doesn't mean we have to own them all. Let's just pick out the best. And clearly, these lower market cap stocks that we picked are better. We have more cash to market cap in terms of percentages, less debt, and so on and so forth. Let's take a look now at cash flow. So net income, Palo Alto Networks, a measly 1.1 billion. 1.1 billion compared to the market cap of 130. That's not. It doesn't get me excited. Actually, not excited. I would say a bit. I'm a bit scared to touch this because the market cap is so huge and the stock looks very overvalued to the amount of money that brings in. And same as CrowdStrike, the margins are not there and they don't show enough consistent improvement. I don't mind. I wouldn't mind the stock having, let's say, minus 1% in operating margins. What it bothers me is that it has remained flat for the past 5-7 years. So when I'm trying to predict something, I look at the past and I look at the numbers and I say, okay, they have been improving 2017 up until 2022, and then they are very flat. This is bad for me. I don't want to invest in this. I want to invest in something like Qualys, of course, which is clearly going up over time. I mean, look at this. And 10 years ago, they were more profitable. And this is a young company as well. How come this company can be a very small market cap company and achieve so much? Even 10 years ago, they were 15% operating margin profitable. So what are we talking about? Why would I put money into something that doesn't seem to go anywhere and has $100 billion in market cap? So when I make an investment, I'm looking to double up my money and I ask myself, when can I double up my money with CrowdStrike? The answer is maybe in 15 years. I mean, it's just, I don't think I can double up my money. It's just very overvalued. But yeah, anyway, net income growth last 5 years. Fortinet, huge, 36%, huge growth. And we're going to take a look at the graph as well. Qualys, 16% over the past 5 years. The other two companies, Palo Alto and CrowdStrike, do not have growth. They were negative at some point. They just didn't grow. So I want to take a look. Fortinet, because I'm interested in this 36%. Let's take a look. Net income. Yeah, as you can see here, the net income is growing and growing, and the average over the past 5 years is 36%, which is great. Amazing. I love it. That's why I put money in. Stock-based compensation. 1.9 billion of net income compared to 266 million. A little bit over 10%. Let's just say 12%, 13%. The free cash flow is around 2 billion, and FCF minus SBC, we're looking at 1.8 billion, around 1.8 billion dollars of money basically that is available to give out to shareholders, or maybe pay down debt, which these companies do not have, or maybe expand their own business, acquire some other companies. So as you can see here, 1.8 billion in free cash flow minus SBC. Actually, it's interesting. Palo Alto Networks has free cash flow of 3.5 billion, but the share-based compensation is much higher than the direct competitor, which is Fortinet. So their FCF minus SBC is very close. But obviously, Fortinet is a $60 billion company. Palo Alto Networks is more than double. So clearly, you don't want to own Palo Alto Networks and you want to go with Fortinet. Same, actually, it's not the same story with CrowdStrike. This is kind of crazy. CrowdStrike is bringing in 1.1 billion in free cash flow, but when you subtract the share-based compensation, you're left with nothing. Okay, my $5 billion Qualys company, $5 billion market cap, is bringing in double the amount in free cash flow compared to CrowdStrike. So that's kind of insane. That's kind of crazy. This is the problem with high stock-based compensation companies. They have a lot of high growth, and they can manipulate that as well. Anyway, I'm not gonna get into it, but yeah, the stock-based compensation is also growing very fast, and it's just gonna eat you up. This is like a plague. You don't want to see this in anything. This is a almost exponential growth. Yeah, not exponential, but 45-degree angle growth in stock-based compensation. What does this mean? This is not gonna stop anytime soon. Okay. So do you see the type of improvement in net income? No, it's negative. I don't want to be invested in this company over the next 5 years. I want this to show, and I mean, it has to grow. It has to reach like $300 and $400 billion market cap. And then the stock-based compensation to stabilize at some point, and they need to bring in tens of billions of dollars in net income for me to even feel good about investing. Obviously, it's gonna change. Obviously, this company is not gonna be doing this thing for much longer. Obviously, it's gonna pop, and we're gonna take a look at valuation next. Let's take a look at valuation. So PE ratio 122 for Palo Alto. Fortinet is at 31, which is a lot more sensible, okay? Look at the S&P. This is SPY, S&P 500, currently is at 26. So much closer to 20 to the S&P, much more sensible. Forward PE is at 30. So this is a high growth company. Fortinet is growing much faster than the S&P average. So you can pay a little bit more than the S&P, but paying 122, yeah, you don't want to pay that, okay? It makes no sense. You have no margin of safety. You take on a lot of risk. It can pop in your face. You can lose a lot of, I mean, look at this. Let's take a look again at the graph. If you don't think stocks can go down by 30% in just a couple of weeks, look at this, Fortinet, minus 30%. Okay, it can drop from all-time high from back in February this year. It was down 35%. Do you want to know what can happen to a massively inflated, and this had a very hard floor because it wasn't so overvalued. But wait until the CrowdStrike pops. Wait until these type of company pop. Minus 66%. And it's probably going to happen again. But yeah, anyway, 4P for Fortinet 50s in the 50s, very, very highly richly priced, richly valued. Qualys is in line with the S&P 500. And Qualys is a very substantial growth, has consistent and substantial growth rate, double digits until 2023, and now around 9%, 10%. This is great. I mean, it's growing faster than the S&P average and is very consistent. This is exactly the type of company that I want to own for this price. I mean, it's not dirt cheap and it's not crazy undervalued, but all of the metrics are much, much better than the S&P 500. And I'm going to be comparing, I'm going to be showing how I will color code all of these metrics compared to the S&P 500 and then compare them a little bit between themselves. But anyway, all of the metrics of Qualys are much better than the S&P 500, and you're buying it today at the same price as the S&P, and 4P is at 21, which is not super dirt cheap, but you can see that it's growing fast, and over time it's going to get cheaper and cheaper and cheaper, which is going to drive the price higher and higher and higher, because it cannot get cheaper indefinitely. At some point, the buyers are going to show up. At some point, the buyers are going to say, okay, this is getting ridiculous. The price to earnings level is very low, so we're just going to buy it. Price to sales. Palo Alto Networks 14, Fortinet 9. Qualys 7 compared to the 25 of CrowdStrike. Ridiculous. Again, price to sales 25. That's insane. Okay, 25 times. So you're paying 25 times the revenue. Yeah, I don't think you will definitely lose money putting money on CrowdStrike. If you invest in CrowdStrike, I'm gonna tell you right now that you will definitely lose money in the upcoming years. Looking at the growth rate, which is not a lot, and the margins, which kind of suck. I mean, it's just gonna pop in your face. EV to sales, same story. EV to EBITDA, Palo Alto Networks 96, but might be an anomaly. We want to take a look at the graph. EV to EBITDA, no. Yep, it's definitely very high. Yeah. For Fortinet, 27 times, it is very high, but let's just compare it to what it was before. Is it improving? So back in 2021, looks like this was in a massive bubble, and it kind of grew into that bubble with the valuation, and you're looking at a decade low valuation here for Fortinet, which is a much better choice rather than to buy it at all-time high. FCF yield, my favorite number when looking at valuations. Fortinet more than 3%, which is better than Palo Alto Networks. It's cheaper and also a bit cheaper than the S&P 500. Qualys, which is 5%, is much, much cheaper than the S&P 500 and 5 times more cheap. It's not that it's 5 times cheaper than the CrowdStrike, but CrowdStrike is in such a massive bubble. It's just going to pop in your face. A lot of people will get hurt. Yeah, I mean, it's kind of ridiculous. It used to be cheap back in 2023. That's when you should have bought it. It was getting very close to S&P 500 levels. Yeah, that's when you could have bought it. Today, no, not at all. You should probably stay away. Okay, so now I want to get into this document and just put green flags. So let's just say gross margins. Is this a green flag? Is this a red flag? 81% for Fortinet and Qualys. I'm gonna put green number 4, and then green number 3 for Palo Alto and CrowdStrike. The S&P 500 average is around 45%. Could fluctuate, could get up to 48, but still 73, 74 is much better than the S&P 500. Obviously, they are in the software business, services. It's normal to see these type of gross margins, but going over 80%, you're closing into more than double. So I like to put in a different kind of shade of green, okay? Operating margins, profit margins. I would say red number one. Why? Because looking at the company that has a market cap of 130 billion, I do not want to have only 11% operating margins. In this type of industry, in high-tech industry, cybersecurity, somewhere where it's not that hard to make more than 20%. I mean, you make less in operating margin profit than the S&P 500 average. The S&P is around 15%. So seeing 11% is a red flag for me. It's not a huge red flag, but it is a slightly red. Minus here for CrowdStrike, I'm just going to put green number 3. Huge red flag. And it didn't show, when we took a look at the graph, it did not show any type of improvement. It was flatlining around minus for the past several years, which is really, really bad. Operating margin, profit margin for our two companies that we own, I'm going to put green 4. Again, in some cases, yeah, we're double the amount of the S&P 500 average. So also the FCF margin, free cash flow margins for all of these companies are in green 4. So that's good for all of them. And then ROIC, like we talked about, it's going to be green 4 for our two companies. And then we're just going to we're going to slap red, slightly red. Let's just put red 3 for CrowdStrike again. So moving on to balance sheet. Total cash. So considering that they are net cash positive, I'm just going to put... I'm going to put green for all of them. Because when comparing to the S&P 500, which is negative net cash, yeah, we're doing fine. We're doing good. But net cash to market cap, some of them are not doing so hot. So for example, here I would put green number 1, green 3, looking at 5% of total market cap, and then over 10%, it's getting ridiculous. Imagine the price of Qualys dropping by 15% or more, and then this cash to market cap gets to even at a high, more absurd level. So I'm just going to slap green number 4 for Qualys. So yeah, shareholders equity 7 billion, 8 billion compared to a market cap of 130. Not a lot. Not either of them. They don't have anything that excites me. But yeah, I'm not going to put any type of flag to it because it's shareholders equity. I just put this number up, but it's not something that is very relevant for me personally. But I want to take a look at total debt. So total debt compared to market cap, of course, everything here is in the green, meaning that we have excess cash, we have net cash, so it's not a lot for any. I mean, 131 billion compared to a debt to 400 million is nothing. Okay, so everything here is going to be green 3, basically no debt. I mean, Qualys 55 million, it's nothing. They have net cash of 500 million. I mean, it's truly nothing. I mean, let's just put green 4 here. Cash flows, net income growth. This is very bad. In the last 5 years, they have not been able to grow their net income. Then Fortinet, I'm going to slap green 4, of course, growing amazingly, and green 3 for Qualys. And then stock-based compensation, like we talked about, for CrowdStrike is going to be red 3. And then Palo Alto Networks, red 1. Because, yeah, it's still a lot compared to... It's around 30% compared to the FCF yield, FCF amount. So, yeah, Fortinet... I'm going to put green 3 for Fortinet, and Qualys is going to be, so FCF minus, let's just put green 3 as well. Yeah, it's less than 30%. Actually, 260 million is going to be green 4. So we're a little bit more than 10% for Fortinet, which is amazing. So again, green 4, green 3 for this, green 3 for the free cash flow around $250 million, and their market cap is 5 billion. I'm gonna put green 4 for free cash flow, green 3, CrowdStrike 1 billion in free cash flow, and their market cap is 109. Very, very richly valued. I don't like it. 3.5 billion. Mm, red one. FCF minus SBC. Red 3 for CrowdStrike. So actually, let's just put green 1 for Palo Alto Networks. And it's not that bad. It's just, yeah, 30%. It's not bad. It's just, it's not concerning. It's just could be better, because we can clearly see in this industry it can be much, much better. So there's no reason. If Fortinet, which is the direct competitor, can maintain a high level of growth without having to pay a lot for talent. So look at this. It's growing nicely. It's getting market cap. It's competing effectively with Palo Alto Networks. And it doesn't have that much stock-based compensation. So if Fortinet can do it, guess what? The other competitor can do it as well. So that's my logic. That's how I see things. If it was other type of industry where all of the competitors of the stocks of the stock that I own and want to buy, if everyone is doing a lot of stock-based compensation because they have to pay for talent, then yeah, it's understandable. But if I have proof and I see that other companies do not pay as much in percentages in stock-based compensation, and they are able to do very well in terms of margins and growth and everything, then yeah, why? I'm not gonna go. I'm gonna say, yeah, it makes no sense. I don't want to buy something that is just gonna dilute me to death and then just not gonna give me the opportunity to have their shares being bought back more effectively, and they're just gonna dilute me in the sense that they pour more money into stock-based compensation. But anyway, let's move on to valuation. P ratio, obviously. CrowdStrike doesn't even have, so red number 3, red number 1 for Palo Alto, same here. Forward PE are both gonna be red 3. I mean, it's red 3 as well for 122 PE ratio. What are we talking about? Price to sales of 24, ridiculous. Enterprise value to sales, Jesus Christ. This is all very bad. EV to EBITDA, CrowdStrike doesn't even have this metric. You cannot. Yeah, it's bad. It's bad. It's bad. FCF yield very bad for CrowdStrike, red 3, and I would say red 1, just because it's slightly lower than the S&P 500 average. I want to buy stuff that it's cheaper than the S&P and also higher quality. And I can do that consistently because there are always bargains out there. So Fortinet, I'm gonna put green number 1, slightly better than the S&P 500 average, and Qualys here is just gonna be green 3. It's not gonna be green 4. It's not 7, 8, or 9%. It's just around 5%, which is quite a bit better than the S&P 500 average. And the rest of the metrics, I'm gonna put green 1, because Fortinet has high growth and it's in line with the S&P 500 average. And I'm gonna put a green 1 as well for EV to EBITDA, even though it's 27 times, which is very rich, but it's at a decade low, which is good. It shows that the company is improving over time and it doesn't just remain richly valued, and it's able to bring down that valuation. Which what does that mean? That means better margin of safety for me. Qualys is gonna be green 1 for the current PE, green 3 for the forward PE. Price to sales ratio and EV to sales, it is high compared to other industries, but not for this type of in the technology sector. Maybe not. I think we're gonna just slap green number 3. EV to EBITDA, we're just gonna put green 1. Yeah, I mean, or Adobe stock is that's trading at 16 or so, 17. Let's just put green 3. Yeah, so Qualys looks like it's very cheap. And what else can we deduct here? A lot of red flags for CrowdStrike. You want to stay away from that stock. Valuation, completely red for CrowdStrike. The cash flows are not looking good. They dilute you to death. They're not bringing in a lot of money. They're not even profitable. Net income, negative. This is just bad. You do not want to touch this. Now, sure, if it goes down by 70%, then you can reevaluate if you want to buy it. But right now, it's not good. Yeah, I guess that was it. Maybe I can include this in the YouTube video description, but yeah, I'm just gonna end the video now. I don't wanna make it too long.